Hello, my name is Charlie Moran. I'm a senior analyst here at Value Line. I'm joined today by three other senior analysts, Alan House, Sharif Abdu, and Nate Hickman. Today we're going to provide an update on the economy and stock market. We will then recommend one stock to buy right now and finally answer any questions you may have. Please note that this presentation will be available on our website, valueline.com, and on our YouTube channel within the next 48 hours. All previous webinars are also posted. Before we get into the presentation, for those joining us for the first time, I want to provide a brief overview of who we are at Value Line. We are a New York headquartered corporation that has been providing investment research for more than 90 years. Our flagship product is the Value Line Investment Survey. This service is a unique source of financial information and is designed to help investors make informed investment decisions that fit their individual goals and levels of risk. The product includes data, information, and analysis on equities that trade on the New York Stock Exchange, the NASDAQ, and the Toronto Stock Exchange. It also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. This service, which is published weekly, is created by Value Line's research department, which is comprised of more than 70 analysts, economists, data experts, and quantitative specialists. Our research is completely unbiased and independent, and unlike many Wall Street brokerage firms, Value Line has no investment banking business with any company, including all the equities under our coverage. Value Line does not execute trades for its subscribers and therefore has no vested interest in whether our subscribers buy, sell, or hold a specific equity or security. What's more, our staff of professional securities analysts are not permitted to own shares of any company that they cover. If you have any questions about the products or services we offer or our different tiers of subscriptions, that information can be found at valueline.com, or you can call 1-800-VALUELINE. Now let's discuss the economy and the stock market. This content was prepared by Value Line's economic staff. The U.S. economy is slowing. True, the first look at the March quarter GDP is expected to show a nice gain, but that will likely prove to be the high water mark for 2023. The Federal Reserve's most restrictive monetary policy course in 4 decades, designed to slow demand for goods and services and ultimately put downward pressure on prices, appears not to be concluded, and its effects are yet to be fully realized. There are already notable pockets of weakness in the economy, particularly the manufacturing and housing sectors. The Conference Board's leading economic index, the LEI, continues to fall. The LEI, which is a set of data that may help to forecast future economic activity, declined 1.2% in March. That was far worse than the 0.5% decline registered in February and the lowest reading since November 2020. For the 6-month period, the LEI was down a notable 4.5%. This, along with the continued inversion of the Treasury market yield curve, suggests a recession is likely later this year. First quarter earnings season remains in focus. There, the results have been mixed. On the positive side, the majority of S&P 500 companies to report thus far have surpassed the lowered expectations, and the results from the banks as a whole did not reveal notable additional stress in the financial system. However, all signs point to the 3-month period being the second consecutive quarterly profit decline. Wall Street is also paying close attention to corporate profit margins. There is growing concerns that companies will not be able to maintain margins that were bolstered by a series of price increases over the last 12 months. If companies get pushback from a consumer sector that is showing signs of spending fatigue, it would hurt margins and ultimately make year-to-year profit comparisons more difficult. In conclusion, investors have taken the corporate earnings news in stride this far, and there's been an orderly reaction by the major equity averages. That said, we still recommend taking a cautious approach given the uncertainty about the near-term economy and how the Federal Reserve plans to manage the monetary policy course in order to avoid a hard landing later this year. Please refer to the inside back cover of Selection and Opinion for our statistically based asset allocation model's current reading. On that note, Value Line is providing a great deal of information and analysis to help our subscribers. We know that most of our users depend on our weekly stock reports, time-tested ranking systems, and other valuable services. In addition, Value Line provides a great deal of daily content that can help you avoid the pitfalls and profit during this volatile time in the stock market. Every business day, senior members of Value Line's research department review the most actively traded stocks, company press releases, news stories, trade periodicals, and other sources for data and information that may change our view and investment recommendations for specific stocks. When something noteworthy crosses our desk, we immediately publish a supplementary report that outlines the new information and, importantly, what it means for the stock and shareholders. This content is posted throughout the day on our website. Again, that is valueline.com. I will now show you how to access it. Once signed in, head to the dashboard where I am already located. This is the main landing page for subscribers. Under the quick links, click on Supplementary Reports. There you go. As you can see, the research department has been busy publishing our updated thoughts on the stocks that we track. We strongly suggest that subscribers visit this page often. Some individual companies incurred a lot of debt or sold stock to improve liquidity over the last few years, especially those dealing with sharply reduced demand for their offerings and supply chain problems, among many issues. So, due to the changing structure of company balance sheets, Value Line has been reviewing and altering our proprietary financial strength grades for the stocks in our coverage universe. These changes are posted each week in our Selection and Opinion newsletter. For those of you that don't know, financial strength along with price stability, another proprietary Value Line measure, are the two metrics that are used to calculate a stock's safety rank, a key measure of risk. When considering a new stock to invest in, we strongly suggest that you utilize financial strength and safety in your decision-making process. For more information in regard to our proprietary ranks and ratings, Value Line provides a user guide that can be accessed via the investment education section of our website. Lastly, this is a good time to mention that the case for individual stocks is quite strong over broad index funds. So now we'll go into the screener and the one stock to buy right now. Let's move forward. For this, Value Line subscribers have access to 15 preset screens and 50 fields. I should also mention that another 100 or so fields are available, but it requires a higher level of subscription. If this interests you, please call 1-800-VALUE-LINE. Okay, and now as we go to the screening criteria, we'll walk through the steps. The current economic climate remains murky, marked by inflation, elevated interest rates, geopolitical tensions, and the possibility of a recession looming on the horizon. So today we want to emphasize a good balance between financial stability and upside potential in the intermediate term. We'll start the screening process by looking at safety and financial strength ranks, both under the Ranks and Ratings tab. If you could scroll to that, there we go. The first choice we're going to have, the first parameter, is a safety rank of 3 or better. There are many risks to measure or to consider, but today we're going to start by applying our time-tested safety ranks. Safety measures the total risk of a stock and is arranged on an easy-to-understand scale from 1 to 5, with 1 being the most conservative issues. I want to highlight the fact that stocks ranked favorably for safety have, in the past, held up far better than the broader market during corrections and downturns. They also meaningfully participate in up markets. For more information, I encourage you to peruse our ranking system guide, which is available free of charge from within the investment education section of our website. We're going to focus on stocks with a safety rank of 3 or better. So by applying that first criteria, we've trimmed our potential candidates down from 5,700 to a little over 2,000 candidates. Okay, so we're going to double down on our security by applying financial strength, which is the next criteria, which is also under the ranks and ratings tab. So for now, let's try a financial strength of B+ or better. Financial strength is already a factor in the calculation for safety, but given the volatility in equity markets of late, we want an additional measure of security. Our financial strength ratings go from C to A++ in 9 increments, with B+ being the midpoint of the range. Today we're going with the companies that garner a financial strength score of B+ or better. And similar to the safety ranks we just used, we want a balance of decent balance sheet and financial stability and upside potential. By applying this criteria, we've cut the list down from a little over 2,000 to, I believe, a little under 1,600. And we're going to look at one stability metric by applying price growth persistence under the ranks and ratings tab. As the name suggests, it measures the persistence of the stock's price growth compared with the average stock. So we're going to go with a price growth persistence ranking of 60 or better. And by applying this criteria, we've cut the list down to 725. We've looked at measures of risk and stability. Now let's apply some performance metrics. We'll return to the ranks and ratings section and look at the industry rank for timeliness. And we are going to choose 10 or better. We've cast a wide net so far, but now we want to filter down to the industries that have the strongest prospects in the coming 6 to 12 months, especially given the current economic environment. And by applying this criteria, we've cut the list down to about, well, exactly 86 candidates. The 5th parameter is timeliness rank, and we're going to choose 2 or better. Timeliness is one of our tried and true measures. It's a proprietary value line metric that evaluates a stock's projected price performance in the coming 6 to 12 months. It's a straightforward scale from 1 to 5, with 1 being the highest. Today we want to focus on stocks that we believe will outperform the overall market, so we're looking at stocks ranked 2 or better. By applying that screen, we've trimmed the list to 52. And now the 6th rank, or the 6th parameter, is the technical rank. And there we are going to look for 2 or better. We're staying in the ranks and ratings section, whereas timeliness attempts to quantify the outlook for the equity in the next 6 to 12 months. Our technical score is focused on the coming 3 to 6 months. We're looking at stocks with a technical score of 2 or better, and now we've got the list down to 41. And we're going to apply one more performance criteria by looking at 18-month target price range midpoint under the company data tab. Expanding our time frame from the short term to the intermediate term, we're looking at stocks with 18-month appreciation potential of 25% or better. By applying the screen, we've narrowed the list to our final 22 candidates. And you can make a strong argument for any of the remaining candidates, and investors interested in adding new positions should consider them. However, only one can be today's one stock to buy right now, and after consulting with a number of senior analysts, we prefer and recommend United Rentals, ticker symbol URI. And before I click on United Rentals, please note that screens can be saved and revisited by utilizing the Create Saved Screen button at the top. Thank you for pointing that out. And let's go to United Rentals presentation, its digital report. And the last full page report. Let's take a look at this. Okay. This was published earlier this month, and as you can see in the statistical array, or the center of the report that includes the financial data, United Rentals revenues and earnings per share advanced 20% and 47% in 2022, driven by higher government-sponsored infrastructure spending. Weakness in the housing market will be an overhang on performance, but one very favorable development is a growing push to onshore critical industries, including important processes in the industrial, manufacturing, and energy sectors. We expect revenues and earnings per share to increase 20% and 26% this year, respectively, and the top and bottom lines may expand another 4% and 8% in 2024, with upside for revenues and earnings beyond that, 4 and 8% if inflation continues to ease and domestic growth picks up. Now, if we look at stock valuation, URI is currently trading at a slight discount of roughly 9 times our earnings per share estimate for 2023, compared with our long-term projection of about 10 times earnings. Another consideration is the company's ample cash flow generation, which we believe market participants will appreciate as earnings growth for corporate America becomes more in question. Taking a look at some quantitative metrics, the stock has solid marks across the board, including a 3 for safety and a B+ for financial strength, price growth persistence of 85, and earnings predictability of 80. The stock has our highest rank of 1 in both the timeliness and technical categories, and the upside in the 18-month window is above average at 25%. To sum it up, United Rentals is set up for strong results in 2023 and 2024, and the stock can form one of the building blocks of a successful portfolio. It is today's one stock to buy right now. We will now tackle your questions. Please note that I typically can't answer complex questions about specific stocks on the spot. For this, I recommend a review of our latest reports. The first few were submitted prior to this presentation, and now I will hand it off to Sharif, Alan, and Nate.
Hi, everyone. I'm Nate Ekman. Our first question is one that was submitted before the webinar. And we were asked, the electric vehicle craze is fully fledged. What picks does Value Line have? Now, as mentioned, we don't typically get into specific stocks here for the One Stock to Buy Right Now webinar, other than the One Stock to Buy Right Now, of course. But in this case, there is something very interesting that we would like to point out, and that is that while there are some very obvious names in the electric vehicle space, right, there's also some great and potentially more stable opportunities for exposure to that space, specifically around the construction of the infrastructure needed to support the recent boom in electric vehicles. Over the last couple of years, a great deal of money has been earmarked for the construction of electric vehicle charging infrastructure, especially high-capacity chargers along national highways, state highways. And in 2022, that build-out hadn't really started yet. Proposals were still being considered and approved. But that process is largely finished now, and we're going to start seeing the build out of that infrastructure over the next year. And certain companies are very well positioned to capitalize on that and to win those contracts. We particularly urge investors to look at companies with exposure to the construction market, especially those capable of dealing with specialized electrical construction, and also with companies that manufacture the specialized electrical equipment that goes into constructing these high-capacity chargers. Companies like that are potentially very well positioned to make some money off of this, and it will only help their performance going forward. So if you are interested in having exposure to electric vehicles but don't necessarily want the kind of volatility that you see with some of the dedicated EV names, that can be one way to do it. If you're interested in that sort of thing, we do have a dedicated climate change investing service with a full portfolio of recommendations, as well as timely news about climate change related issues pertinent to investors and analysis of those issues.
Thank you, Nate. I also, this is Alan. I also see an interesting question that just came up. Someone asked about, the different, performance periods that we look at. And, Value Line is known for its timeliness ranking system, which generally looks at things through like a 6 to 12 month lens. And we also use the 3 to 5 year investment horizon for one of our as one of our metrics. Then probably 4 or 5 years ago, we realized that there's some investors, some subscribers that look at things, they want more of an intermediate term. So that's why we have now included the 18-month target price range, which we feel is a good kind of middle ground between near-term performance and longer-term performance. So we definitely key in on that for many of our stocks, and we think that's another important indicator to look at, based on what your objectives are. There's also a question that somebody has regarding the level of subscription. I would suggest calling 1-800-VALUE line. They'll be able to give you detailed information about levels of subscription and things like that. So that's 1-800-VALUE line.
We've also got a question here about can you select mutual funds as well? And to that, I would say primarily our services deal with stocks. However, we do have several services dealing with ETFs, exchange-traded funds. So if that's something that interests you, we do have those options available for subscribers to those specialized services.
Okay, I see a question from John about, can someone elaborate on the current position? The current position is basically Value Line's way of looking at the liquidity of a company. As you can see in United Rentals situation, it has, the current assets, current liabilities. It's roughly just over 1-to-1, right around 1-to-1. Looks like for the most recent period, just slightly over 1-to-1. We believe that's a good way of looking at the liquidity. of a company, how its current assets can meet its current obligations. So, that's another important area to look at. It sits right below the capital structure, which is basically, the debt to equity of the company. It also has any leases that the company has. If it has a defined pension plan, we list that as well. As you can see in United Rental situation, debt to capital is about 61% as of the end of last year. That may seem a tad high at first blush, but given the industry it's in, it's pretty standard for that industry because it is capital intensive. So not everything can be looked at on an apples to apples basis. We like to look at things more like industry by industry. Okay, thank you all. Thank you all for joining us.